got to get out in the next 10 minutes, Katie, because your time is valuable and everyone else's. So let's get to it. Making your first futures options trade. It sounds really scary and daunting. Futures options, double derivatives. Derivatives to begin with seem scary, Katie. But at the end of the day, they're just they're different ways to get paid, right?
Exactly. I mean, you went to school for like math, and I was a broadcast journalism major covering God knows what. Ooh, excuse me. Covering, I don't even know what back when I was in school. And so I didn't even know that derivative products existed in college. Like I really thought there was just like stock. So coming to work at Tasty Trade was really eye-opening to me that like you can trade these other products and put probability in your favor and rather give yourself a better than 50-50 shot. So that is like such a powerful thing for people out there who might be apprehensive to trading derivatives because of like the doom or the risk involved with them. I just think, like you said, it's just another tool that you can add to your toolbox that enables you to stay active and to get creative with all of the different ways you could speculate.
Totally right. I think that unfortunately, the way that the landscape has existed in trading or just like managing your money, investing, whatever you want to call it, for the last several decades, Katie, it's been like, okay, I as an individual, everyday person can buy stock and then everything else is left to the professionals because derivatives, that's a multi-syllabic word. And I don't know what it means. And it sounds scary and everything else. Futures, oh, really scary. Options, calls and puts, what the hell are you talking about? At its core, everybody, and the market that we're talking about today is metals. So just gold and silver, stuff that you've heard about, okay? And you've probably even seen the price in different news items. Oh, the price of gold is up. The price of silver is down, whatever it is. In my mind, Katie, it's just like market that you're looking at or asset that you're looking at. Today, it's metals. It moves up or down. And then you have futures that move up or down with that price. And then you have call and put options that move as functions of that futures or initial market in gold and silver. It's all just like the same market at the end of the day, but the futures and options, whichever type of derivative you're looking at, or today futures options, which is essentially a second derivative. Those math heads at home know what I said. Math heads, not meth heads, but math heads at home know what I'm talking about with second derivatives here. You're just looking at still a market at the end of the day, Katie, that goes up or down, but I'm just strategizing around it and finding different ways to get paid on that movement. And I think the place that most people start in options specifically and derivatives in general is the long call option, because it's essentially just a defined risk bullish strategy that gets you paid at a certain strike and above. So in this scenario, Katie, we have the small metals futures, right? Let's say for today's argument, the price of small metals futures are $73. And that's just a combination of gold and silver prices there. If I buy the 76 call for 60 cents, Katie, essentially I'm getting long that metals market. I have long exposure, but I only get paid above $60. And what's really nice though, and a lot of people I think are calmed by when they're first starting out in derivatives, Katie, is that I'm only paying 60 cents. Metals could go down to zero and I only lose 60 cents. This is, I think, as basic a starting place as you can get.
Exactly. Yeah. It's very translatable for somebody who understands the idea of like, you like something, you buy it. And especially because I've been slowly kind of trying to teach my dad about trading, and he's still a little apprehensive when it comes to options. But this is a clear-cut example of why it is so simple, because you are defining your risk. It's not all is lost or I'm going to get blown out if this doesn't come to fruition.
Exactly right. And on the flip side of that, and this is what's really nice about all of these derivatives, every single market, there's a yin and a yang, right? Like I can also get in there and I can sell that call for 60 cents. And yes, I have undefined risk theoretically. If this market goes to 100, well, then I just lost the difference between my short call strike and 100. Oh man, I just lost $24 there. That stinks. And I only got paid 60 cents for this. But doing that is a high probability play, right? The market needs to get up to 76 for me to start losing money. And you can see here in the last year, the market has only gotten as high as almost $80. And so there's always push and pull. There's always pros and cons to being long or short options. There's never, I think a lot of people, I'm sorry to say this, a lot of people foolishly, when they're entering derivatives, they always think like, oh, well, I'll just buy the call because, I can only lose 60 cents and I can make a ton of money. And it's like, well, right. Yeah, you can make a ton of money, but the odds of you making a ton of money is small. And so payout potential big, probability of you making money small. And then on the short side of options, Katie, probability of you making money high and payout small. And so these things are extremely efficient in markets here in the derivative space, right?
Yes, I think you just hit on such a great point. We actually just released a blog about it on the Tasty Trade website, where there is this whole subgroup of traders who are so used to the instant gratification of meme stocks. And that's not necessarily a sustainable, practice for you. It's fine to do that and dabble in that if you really have some type of really strong interest in a particular product. But if you're talking about building a skill set, being flexible is definitely, in my opinion, the way to go.
Absolutely. And with that flexibility, you have put options, which we don't need to necessarily spiel about here, but it's the same kind of thing, but to the downside. I can buy a 70 put for 40 cents in this market, Katie, and I'm bearish. I've got defined risk bearish exposure, but I only start getting paid on metals moving lower if they get down to 70 and below. And if I sell that put, okay, I want the market to move higher or stay put. A high probability of me winning because the market just needs to stay above 70, which it has a lot of the time, but I only get that 40 cents. The payout potential is smaller there. So you've got calls and puts in futures options here. You've got the ability to buy or sell them, essentially 4 different strategies starting out. My whole thing, and I think you would agree, when starting out and making your first futures options trade, Katie, it's the same way that I would try my first stock trade, my first futures trade, my first options on stock trade, anything. To me, it's always just like, choose one of these 4 options that you think, just like jives with what you see in the market right now, or just whatever of those 4 things that Katie and I just went over, like which one of them were you like, oh, that seems about right for me and this market right now. Choose that, stay small with these small futures options, watch it tick. And you could even close this during the day. There's no pattern day trading, and then just manage for a small profit or loss. Like if I sell this 70 put for 40 cents, Katie, and it's my first futures options trade, I'll just tell myself, all right, I'm going to buy it back at 30 cents for a 10-cent profit, or I'll buy it back at 50 cents for a 10-cent loss. And that's my first trade, low risk, small, hopefully easy for everybody to understand. Does that all make sense?
Yeah, absolutely. And I think the other thing worth mentioning here too is, one thing I do like, especially because, of course, this is just the first of many futures options that will be coming to the small exchange products, but you guys have already done a little bit of the hard work for the trader in the sense that you're serving up 2 different expiration cycles. And right now you're 51 days to expiration and 23. So for me, I hate to have to make a ton of decisions when it comes to my trading because I already have to make decisions in other components of my day job. So sure. You guys have already whittled it down for me. And now I just have to pick, okay, do I have this idea for 3 weeks or do I have it for, closer to a month and a half, 2 months?
Easy enough. There you go. You have it there. You've got the timing, you've got the call, the put, the buy, the sell, all the ideas you need to make your first futures options trade. Thanks so much, Katie, for joining us as she does every Wednesday. Go follow her on Twitter and bug her and give her praise and everything else. Katie is seriously tops in my book. But anyways, thank you all for watching Small Stakes. We'll be back here tomorrow. Hopefully you have a good FOMC trade. You're going to have a great next segment, Splash into Futures with Pete Moment, coming up next. Hang out for that, everybody. Thanks. Peace.